Welcome back to Lamb's Cryptoverse, everyone, or I should say maybe Macroverse, because we're going to cover a lot of things today, but quickly. I usually do long notes and PowerPoint presentations, but today I have limited amount of time, but I want to get something out there. I think we're in danger zones, and my definition of a danger zone is when we have confluence. So what's confluence? As I explained a few times, confluence is when you have data from different data sets, or indicators, I should say, from different data sets that give you the same result. And what I'm saying is I'm seeing that we're now in a very high risk danger zone. And this is because we're seeing data from, like I said, different data sets, basically fundamental, sentiment, technical, different asset classes. They're all saying that we're in a danger zone for capital markets. So I'm going to go through a few charts quickly. I can't go through everything because there's just a lot to say. And remember, when I talk about charts, I'm not using anecdotal data, because what happens is every day we're hit with, I call it noise. Like someone on Twitter or LinkedIn or Substack or Medium, they'll point out a chart that says, oh my God, we've never seen this before. We've never seen the commitment of traders say this. We've never seen the put-to-call ratio say that. We've never seen so many people negative on Bank of America's asset manager survey or on the consumer surveys. Like they're using surveys or data points that no one uses on a consistent basis. But the data I'm presented to you is data that I use consistently. And if not, it's only data that I think is pretty good. So let's get started. The first one I want to talk to you about, and let me minimize myself, is this. This, as you know, is the, whoops, let me whoa, this moves quickly. This is S&P 500. There we go. It basically is unchanged. And if you remember, I put out many videos saying, including when I was bullish and bearish in both videos, I said we could get to about 4150 on S&P. And so we're close enough, so it's a good time for me to say, hey, we're at a danger zone. So a reason I'm saying we're at a danger zone, many reasons, but we're breaching the trend line, so that's bad. And there's other reasons too, but I said the same thing with Bitcoin. I said when Bitcoin was down here at 16,000, I think that's when I said it. I said we could reach about 28,000 and maybe 31,000. Then I said we couldn't go higher than that because of the trend line and overhead resistance that occurred back here when we had issues with Terra Lunar and then FTX bankruptcy / Alameda bankruptcy. We have a lot of issues. And also we broke a short-term trend line here. So I think this is negative. Some people are going to say it's bullish. I think it's bearish. Yes, we broke the trend line. You could say that's bullish, but it's bearish because we're hitting overhead resistance. But there's many other things. I'm not just using this as a bearish signal. There are many other signs. Before we go to that, I want to show you the heat map for today. Bitcoin is, everything is green except Solana, but that's been doing really well. And you can see Ethereum just successfully passed its Shanghai upgrade, and that means that everyone that's staked for many months on the Beacon testnet can now remove all that staked Ethereum. So I thought that was going to make Ethereum go down a few percent, but that did not happen. I guess it was sell on the news kind of thing. And buy on when it actually went through. So that's a very good sign that there haven't been any dumping of staked Ethereum. And as a matter of fact, there's been some new stakers coming on as validators. So as validators have been exiting, there have been some new stakers coming on. But there's still, for the next 2 weeks, there's still going to be a lot of validators coming on. I just saw that this updated. Now Ethereum's up 5.5% today. And this is on top of an 11% move yesterday. So this is an amazing move. And if you look at the last month, You could see Ethereum had a 30% move and Bitcoin a 29% move. This is unbelievable. These are really, really good moves. So what this is causing is too much optimism. I don't have time to show you all the on-chain metrics, but I could tell you about one. One is the SOPR. This is the amount of recently acquired Bitcoin that is in profit. That is, it's at 75%. So 75% of all recent Bitcoin purchases are on profit. So to me, that's saying to me that it's in an overbought situation. So this is just looking at the put to call ratio. I just want to point out that it went from a low number of 0.226 in Ethereum up to 0.44. So these are still low numbers, but it almost doubled. So that was showing that there was some pessimism in Ethereum, and that's why it went up. Because remember, the put to call is a contrarian indicator. But overall, I still think these are at low numbers. But let's get to what I want to talk about today, which is I think the market is overbought. And the first thing I want to show you is leading indicators. I think we're going to reach stage 2 of the stock market going down. Stage 1 was when the price to earnings ratio went down because it was just too high. Stage 2 is going to be lower earnings estimates. That's going to happen when there's a recession. But what I want to say is we haven't seen that yet. We're still at a tipping point. And even the P ratio, it's too high. The PE ratio for the S&P 500 is approaching 19. That's a very high number. So that could go down and the earnings estimates could go down. But if you look at leading indicators, we haven't gone down that much. And you could see we're approaching a low level, but we're not there. Like if you look at this one, this is a smooth U.S. recession probability. And if you look at the bottom at the definition, it uses a dynamic factor Markov switching model. That's why it's almost like a binary thing. So it goes from 0 to 1 kind of thing. So you could see basically the word 0. So it's not indicating a recession. So because of that, earnings estimates are not diving, but we're very close to that tipping point of earnings estimates going down quickly. And if you look at the SOM Real Recession Indicator, it's also near 0. And the reason why this is near 0 is because this recession indicator is heavily weighted on unemployment. And unemployment right now is around 3.6, 3.7%. That's at a historical low. And the last indicator I want to show you is financial stress. It ticked up during the banking crisis. Now we're back down again. So let's turn to sentiment. This is why I'm very negative on capital markets. The CNN Fear Greed Index is at 69. So it's near the high that we saw in both January and February of 2023 before the market declined. So I think we're at a very, very dangerous moment here. And here's the overall number. You could see we're at greed territory. And if you're looking at crypto, we see the same thing. The crypto fear greed index is at 68. So it could get higher than that. We can reach basically 100, where there's extreme optimism and Bitcoin's going up like crazy. But the point is, I like to look at everything from a risk management point of view. So once we enter the greed zone, that's when things are looking dangerous. And if you look here at a 1 year, you could see we're at a highest level in 1 year. And if we go to max, you could see with the highest level, let me minimize this so you could see the months here. So now you can see with the highest level since November 21 and even higher than March 22. This is before Bitcoin declined. So March 22 was a short-term peak in Bitcoin. So we've breached that level of greed. So I think we need to be careful in terms of that. Now I want to go to my own indicators. Let me just minimize myself here. This keep getting in the way of everything. So here, this is something I created recently, only in June of 21. It's called a daily indicator. And this indicator, when it's high, it's bullish, and when it's low, it's bearish. But basically, most of the time, it stays in the middle. And you could see, maybe you can see, there's a gray trend line here. So the blue line here is the bullish line, and the red line is bearish. So it became bearish, very bearish, near the market peak of November 21. You could see it went below the red line. And ever since, it's been basically in the middle. But it did become bullish in January 23. So basically, it said that the market can continue going up, and actually put out a bullish video at that time. But then it became bearish again more recently, I guess it's about a month ago. And ever since, it's been in neutral territory. So to me, this is at a level where the market could go down. So this is a level saying danger zone. The last chart I want to show you is my sentiment risk indicator. And these indicators, I'm not sure if I mentioned to you, I test them on a forward basis. So this indicator I've been testing for at least 25 years. Not historical testing, not back testing, forward testing, 25 years. Yeah, I know that's a long time. And again, this indicator is the same thing. When it's above this blue line, it's bullish. And when it's below this red line, it's bearish. Now, when there's a regime change, it does not need to reach that red line, because basically we're in a bear market. At least that's the way I see it. And so it's not going to go all the way down. So that's why the green, I think the green label here, the green indicator of 4.33 is low enough. It's sufficiently low enough for the market could go down. So you could see here it became very bullish during the COVID outbreak. And then it became bullish again in May of 22. That's after the market declined quite a bit. And then it became bullish again near the market bottom of October of 2022. And then it became bullish yet again in January 23. And remember, if you recall, my daily indicator, I'm going to go to it. In January 23, also became bullish. So I had many indicators, and including sentiment indicators that I showed you earlier, that became bullish in January 23. And these are like I'm using them as short-term bull-bear indicators because I believe we're in a new regime of higher rates, and we're in a bear market. I believe, unlike many others, that we're still in a bear market. So going back to this sentiment indicator, what it's saying now is at this level, the market can go down. So you might be saying, but we're not in a red zone here. Why do you think the market could go down? Because we're in a new regime. What I did, I'm not showing you on this chart here, but I guess I could show you if I find my other charts. I went back to many other regimes, including, you probably can't see it here, the financial crisis. So here, we had a regime of financial risk, right? Because the banks were going bust because of CLOs and the mortgage crisis. And you could see the indicator is bullish when it breaches this blue line and bearish when it gets to the red line, but it never got to the red line. That's because, like I said, we're in a regime change. So when you regime change, the indicator doesn't go too low. So you could see here, it went down, so it reached a very high level during the Lehman crisis. And then it went down to 5.85, which is much higher than it could be. It could have been down to 5 or 4. Yet the stock market still went down. This is because, like I said, we're in a regime change. And you see a good example of this. If you don't trust me or believe me, or you don't have the data that I'm looking at, you can just look at the VIX. The VIX also has regime changes, and the VIX, as you know, only hits historical low levels when we have low volatility and a regime where interest rates are very low. And we didn't have that in 2008, and we don't have that now anymore. You're not going to see the VIX breaching 17 and going back down to 10 like it did years earlier, because it's just a different regime. So this is why you have to be very careful when you're looking at these data. They all have to be adjusted. Like the PE ratio is a good example. PE ratios, they can hit low levels depending on the regime of interest rates. So if we're in a regime where interest rates are 10%, you're not going to have that P ratio ever going really, really low. So they're going to stay higher, maybe at 10 or 15. But if we have interest rates at 0, you can see P ratios staying much higher because they're affected by interest rates. I know this is a lot to digest, but what I'm trying to tell you is that we're in a regime change where rates, where capital markets can get much lower. And so I'm saying this is a good place to sell and maybe buy treasury bills, treasury bonds. Of course, this is not financial advice. So again, we're at greed and CNN fear greed index. We're at greed for the crypto index. And my indexes are also saying we're at a high risk level. So I see very few indicators saying that we can do better. There are some, like the commitment of traders. Basically, the futures markets are saying that there's still a lot of short selling out there. If there's a lot of short selling of futures, the market could go higher. But that data is being outnumbered by all these other indicators that I'm showing you, like the fear greed index and my sentiment indicator. Well, thank you for listening. Sorry it was a bit confusing.